Very pleased today to release a paper on the debt problem in the United States, written by Stephen Richardson, an executive fellow to the School of Public Policy, and former Associate Deputy Minister of Finance in Canada. Today we're just a few days away from the U.S. Congress and the President of the United States making a very important decision about whether to raise the federal debt ceiling. That decision will have huge implications for the United States, Canada, and the world economy. Let me spell out the implications to the world economy as simply as I can. If we do not see an increase in the debt limit and the United States defaults on its debt, we will see an immediate sell-off of the U.S. dollar and higher interest rates in the United States that will not only affect government borrowing, but also borrowing by people and businesses in the United States. This kind of impact will also affect the whole world economy, as people are going to be very concerned about a significant global recession that could result from that default. I'm confident that both Congress and the President will have clear heads, and they will raise the debt limit so the United States will not default on its debt. However, even with that action, which will only help for the next several years, the U.S. still has a mountain of debt to deal with and a humongous problem in terms of a major fiscal issue to deal with over the coming years. And what will be required is going to be some very painful restructuring of the U.S. government, including spending cuts as well as tax increases. My colleague Steve Richardson carefully looks at a number of measures that would need to be taken by the U.S. government in order to deal with its fiscal problem. It includes, for example, reform of healthcare, also the Social Security system. These were measures that are being adopted in other countries when they faced similar problems. They will also have to undertake spending reductions in a number of areas. But probably most important is that they'll have to increase the taxes to some level, but they should also carry out tax reform. Stephen looked at the adoption of a value-added tax similar to the one we have in Canada, and a 10% value-added tax in the United States would raise roughly $500 billion today, and that would go a significant way, but not solving the whole problem. Regardless of the scenario, there are serious implications for Canada. If there is a U.S. default, a run on the American dollar, we will see a fastly rising Canadian dollar initially. But the slowdown in the United States will impact Canada very much because we're so heavily exposed, as 75% of our trade is with the United States. If the United States doesn't default on its debt, but seriously deals with its fiscal problem, in the long run, that will be good for Canada. But in the short run, we will face consequences because the U.S. will have slow growth, and given that it's our major export market, it'll impact on our growth as well. What Canadians need to do is think about risk management. Governments and people and businesses. And if there's going to be a problem in the future, or the slowdown in the United States, at least be prepared that there could be some negative consequences that we're going to have to live through. And so the best advice I give for governments today is move faster in dealing with your deficits and your debt, and that includes not just the federal government, but also the provincial governments that have a significant problem on their hands. I'm Jack Mintz. This is the School of Public Policy.